Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We're very cautious. So I think boring is better in the very short term if we're sticking with the U.S. So staples and utilities come to mind. Of course, we know, they've held up a bit better because what we're seeing is just sort of a wave of sort of weaker hands. Some of that is sort of momentum investors, whether that's retail investors or hedge funds, who is selling very aggressively. But at the same time, and we're seeing this with our ETFs, there's still sort of a bid in the markets. So people are still allocating to equities, but they're doing so while the share price continues to decline at large.
We are super excited to be announcing the close of our acquisition of ZT Systems. ZT is a phenomenal team. And we are now, when you think about AI infrastructure, what we've learned is that customers really need really an end-to-end AI capability, hardware, software, systems, really to get AI in practice as soon as possible. And ZT is a key part of our overall tool chest, and it's super great to have it closed today.
I'm concerned about higher inflation and slower growth, so that's what's putting the Fed in a very difficult dilemma. They're going to be missing on both sides of their dual mandate objectives. The inflation is going to be too high, and the labor market's going to be on the softer side. I think the key is going to be what happens to the unemployment rate. If the unemployment rate goes up significantly, then the Fed will ultimately cut interest rates.
We've got 1 hour to go now until the market close, and we're just moments away from hearing from New York Federal Reserve President John Williams. He's going to be speaking with our very own Jennifer Schonberger in just a few minutes. Right now, though, I am now joined by Christine Short, Head of Corporate Event Research at Wall Street Horizon, a TMX company. Christine, great to see you and to have you here. Welcome to the show.
Thank you so much for having me.
So let's take a look at these markets, Christine. I'm just looking at the popular averages. Some interesting moves in today's trade. I got the Dow, Christine, now up triple digits, 315 points. The S&P 500 clawing its way back to positive territory. Look at that, we're about 0.2%. And yes, the tech-heavy NASDAQ, all right, we're down about 0.5%, but you are well off session lows. I got Treasuries, little change. I've got gold touching the new high. By the way, yellow metal on pace for best quarterly performance in nearly 40 years. What do you make of it all, Christine? Walk us through it.
Yeah, a bit of a turnaround, right? You see the trepidation around some of these growth names, specifically within tech. You mentioned the NASDAQ and NVIDIA and Meta, not having a great day yet, turning to some of the more staples or defensive names like Walmart, like Coca-Cola. And so a bit of a flight to safety of sorts, within equities, moving away from those names that there's still a bit of uncertainty around. Obviously, earlier in the day, a lot of this trepidation was around tariff uncertainty. We've got Liberation Day coming on Wednesday. We're not really sure how to price that in. Tariff risks, clearly still, we thought it was all priced in. It's not, because even on Wednesday, while we'll get a little bit of clarity, we know there'll still be a negotiation period. So the scope of tariffs, the timing is still unclear.
Very good point, because you have Liberation Day, but we don't know exactly what Liberation Day means.
Right.
What are the specifics? What are the details? We did have some strategists last week, Christine, I'll get your thoughts on this, who were more kind of generally constructive on the market near term. And I think their point was, yes, a lot of spooky headlines are coming. But some of these strategists came on the show and said they felt like a lot of that bad news was priced in. In that you're about 10% off the top.
Right.
And they were also looking at these sentiment gauges. They were looking at investor sentiment gauges, and they were saying, wow, there's a lot of bearishness out there. To them, there was a potentially bullish contrarian indicator. What do you make of that?
Yeah, it's funny with the sentiment indicators because even retail sale, the U of M survey of consumers, and then you had the Conference Board's survey of consumer confidence. Both of those have been plummeting, right? It's like a very dark, scary story. But then when you look at retail sales, consumer spending, sure, a little lighter, but not dropping by the same amount. consumers are inflation resistant. We've seen that, right? They'll continue to spend even as prices get higher. The one thing you have to look at with the consumer is how secure do they feel in their job, in their ability to keep their job, or if they were to lose it, how long would it take them to get another one? We know consumer spending is 2/3 of GDP, so we really need the U.S. consumer to continue to be out there spending, and for the most part they do, which is why the U.S. has such a great economy. But in this scenario, and we get jobs data on Friday, that's really the one thing I'm going to be looking at. Because as you point out, we've seen this dichotomy between sentiment, but then what people are actually doing. And I agree with the strategist you're referring to, where the base case for the markets and for the economy hasn't really changed entirely. Even for some of these tech names, they're still looking for pretty high profits when we get to earnings season next week. So the base case hasn't entirely changed, but it is the uncertainty, and that's why you're seeing investors react to that. You're seeing consumers react to that because they don't quite know what's happening over the next 12 months.
To your point, big jobs report on deck. We're all waiting for it. Well, for a look into how the Fed is navigating tariff uncertainty, let's get to Yahoo Finance's very own Jennifer Schonberger, who is standing by with New York Federal Reserve Bank President John Williams. Jen, over to you.
Thank you, Josh. President Williams, thank you so much for sitting down with me. It's great to see you.
And welcome to the New York Fed.
Thank you so much for having me. The president set to announce reciprocal tariffs on Wednesday, though it appears there may be a multitude of other options on the table, again, including blanketed tariffs. This, of course, on top of 25% tariffs that have been announced on all cars and car parts that are being imported into this country, 25% tariffs on aluminum and steel, tariffs on China, and 25% tariffs on Canada and Mexico that could get back in. So how are you thinking about the impact of all of these tariffs?
Well, clearly we have our, economists studying these issues. We've looked back at the history of where tariffs have been imposed in the past and looked at what we've seen in the effects in terms of prices for those, in terms of the effects on economic activity. So we've been looking at a lot of that analysis and trying to understand what those potential effects could be. Now, it's still early days, as you're mentioning. We're still awaiting more news about what tariffs will be implemented, what the timeline is for that, and other actions around that. So I'd still highlight there's a lot of uncertainty, but really looking carefully, I think we'll be, from my point of view, looking carefully at what actually, is implemented, what other countries may do, but also watching the data. And I think this is the most important part. It's one thing to have models that say, tariffs clearly increase prices in the U.S. That's I think, pretty convincing evidence of that in the past. It affects decisions that businesses make. But we really want to watch the data, especially the data on prices and activities in the affected industry. So that's something we've been watching already and continue to look at as time goes on.
Fed Chair Powell has said that his base case scenario is that any inflation from tariffs could prove transitory. But we've heard from some of your colleagues at the Boston Fed and the St. Louis Fed who are worried about potential long-lasting effects for inflation. St. Louis Fed President Alberto Musalem brought up the notion of domestic producers increasing prices in concert with importers. We also know that we're going to see tariffs on intermediate goods that could ripple through the supply chain. So how are you thinking about the potential for prolonged effects when it comes to inflation and tariffs?
Well, you've highlighted a number of channels where you could get more prolonged effects. So the example that you gave about intermediate inputs, those increase costs for American producers. It takes some time for those to get into consumer prices and show up in inflation. So that's definitely a channel that past history teaches us may take a few years to be fully seen in the data. But there's other questions out there, or how does it spill over to other goods and services in the economy? So I would say it's still early days, and to be able to come to a concrete conclusion around this, I think one is, yes, we will see tariffs affect prices, and then we'll just have to keep watching how do those cascade into prices, downstream to other goods in the economy? What do we see the effects on kind of other goods being produced in the U.S. and really have an open mind about how long these last in terms of their effects on inflation and on the economy?
You said it could take a couple of years for this to filter through. So do you think this is going to be slow moving, or some people have said it could be fast moving?
Well, I think it will be both. So I think the answer to a lot of your questions is really yes, because I think all of these things will happen. One is on consumer goods. I think the history there is you see pretty strong pass-through that happens pretty quickly. But it still might, depending on the market, businesses might take their time in changing their prices. So that may take a matter of months or so. It's really on these intermediate inputs or maybe indirect effects that I think that the effects might not be felt maybe for a couple years fully felt. So I think we have to watch kind of all these channels. So the way I view it is we need to be really looking at the granular data and understanding what is happening, direct effects on tariffs, on prices, but also some of the indirect effects that might filter through the broader economy.
Looking at the latest inflation data, your preferred inflation index, core PCE, jumped up to 2.8% in February. It's already at the increased median forecast for inflation this year for the Fed officials. And this is before we've seen some of the most aggressive slate of tariffs really kick in. So how much upside risk is there to your inflation forecast? Could we be looking at inflation potentially over 3% this year, given that we're already at 2.8?
So I think that there is definitely a risk to inflation being higher than is in the forecast. Of course, if you look at the projections that my colleagues and I, put together for the last FOMC meeting, you saw a very broad view across the participants of the committee that there were upside risks to the inflation outlook there. So I think that that's completely consistent with how I personally view it. I think that my base, my forecast, if you will, is that inflation will be relatively stable, perhaps this year, but definitely there's upside risks depending a lot on these on the tariffs and other policies that may take place.
Is the potential for higher inflation greater in the near term than the risks to growth and employment?
Oh, that's a hard question. I think, again, going back to the projections that we put out, I mean, you look there, you see a upside risk to inflation that I mentioned, but also predominantly downside risk to the economic outlook. I think the uncertainty is very high. I think that's something that everybody is saying. I know I say a lot in my recent public remarks, but also I think the uncertainty has shifted somewhat. More concerns about maybe a slowing of growth in the U.S. economy more than before, but also greater nearer term risk to inflation. I can't personally weigh which is greater. I think they're both very important.
On growth, when you look longer term, some economists have chalked up the tariffs to a big tax hike on consumers, saying that could zap consumer spending and ultimately hurt growth. The president has not ruled out a recession. Treasury Secretary Scott Bessent has said we could see an adjustment. We are seeing a lot of houses on Wall Street raise their forecasts for recession. Are the odds for a recession rising?
Well, I'm not going to try to make a prediction about the odds of recession. I think that's just very hard to do. Clearly, where we are today is an economy that's very solid. We have a labor market that's strong and in good balance. We've seen very good growth up to this point. So I feel like the economy's in a very good place. But I think what people are, I think, seeing is that there's a lot of uncertainty about how the economy will evolve, and a lot of uncertainty about, first of all, the policy actions. We'll see about that, but also how the U.S. economy, and I would say importantly the global economy, respond to these developments.
To your point, the economy looks like it's on fine footing right now. If you look at the so-called hard data, the official data, the pace of hiring has slowed a bit in the first couple months this year. We saw a bit of softness in the retail sales numbers. Of course, that could be chalked up to colder weather. But you look at the consumer sentiment surveys, and those have plunged. Yeah. So my question is the soft data leading the hard data? I mean, you look at the CapEx numbers, right?
Yeah. So this is always a question that we ask ourselves, for as long as I can remember. And we do want to see real data on consumer spending and employment. We'll get that data. We'll get more real, kind of hard data on the economy, and that is really important. Let's see what actually is happening, rather than maybe how people respond to surveys. That said, I'm not totally discounting what I'm hearing from surveys and from business contacts that I talk to. Definitely, uncertainty is high on people's minds. People are, talking a lot about, and I think this shows up in surveys of households and businesses, that they're not quite sure how these policies are going to kind of play out, and maybe taking some time to assess what's happening and make some put off maybe some decisions that they might have made earlier. So I think that the uncertainty itself, regardless of what the policies are, probably is affecting some household and business behavior. And of course, the tariffs themselves, as you mentioned, that will affect businesses' decisions as well.
With the policies being laid out by the administration and given your outlook for higher inflation and lower growth, are we basically facing stagflation? And if not at this point, are you growing concerned that that could take root? And can you assure Americans that you won't allow a 1970s situation take root when it comes to inflation?
So let me start with your last question. Yes, I can assure Americans that we will not allow a high inflation to take root like we saw in the 70s and 80s. When I think about my whole career that's over 30 years now in the Federal Reserve, it's a really important focus is to make sure that we don't have to relive anything like we experienced in the 70s and 80s. And that's part of the reason, of course, that Chair Powell and the FOMC have been absolutely committed to bringing inflation back down as quickly as possible to our 2% goal, and that's what we're very much committed to achieving now. Now that said, as you pointed out, some of the risks are out there in terms of achieving our goals, are obviously something we'll be very closely watching and trying to make sure that we achieve that 2% inflation goal over time, and do it in a way that is very attentive to our maximum employment goal. So our communication out of the FOMC meeting, and in my communication and the chair's communication, is really focused that we have two goals. We're very focused and committed to achieving both of them, and absolutely making sure that higher inflation doesn't take root.
So, but stagflation now or no?
It's not stagflation now. I mean, right now we're in a situation of a 4.1% unemployment rate, 2.5% inflation rate. My focus is trying to maintain that kind of economy as best as we can. Again, in the context of ensuring that we get inflation back down to 2% on a sustained basis.
You said in a speech recently that you expect lower immigration, and that could constrain workers, the increase in workers, I should say, in the job market, putting a damper on growth. I'm wondering, you've also talked to your contacts who have talked about uncertainty, perhaps putting hiring plans on hold. Given all of that, your outlook for lower immigration, the federal job cuts that we're seeing, as well as the potential for any impact from tariffs, how much of a deterioration could we see in the job market?
Well, that's a hard question to answer because you're talking about both supply and demand factors of a complex set of issues. My own view is the economy will continue to grow, but somewhat slower than we saw last year. We've seen some slowing already in the data, but still it's in the context of an economy that's growing and a pretty low unemployment rate. So when I think about this, we have to, as policymakers, we have to look at all the influences on the economy, both domestic, internationally, and these other policy things that you're mentioning, and basically try to assess how do we best achieve maximum employment, price stability, and what's the stance of monetary policy that will maximize our chances of getting there. Right now, this is an economy that has been making really remarkable progress towards achieving our goals. We have monetary policy really well positioned to navigate a time of heightened uncertainty, and then and take whatever is appropriate actions to make sure that we achieve those goals.
If I could characterize our interview so far, I think the buzzword is uncertainty.
Right.
We know that there are inflation risks to the upside. Given these factors, do you anticipate that you could hold rates at current levels for longer?
I think that the current level of the federal funds rate, the target range the FOMC sets, is really well positioned. I feel like monetary policy is moderately restrictive. It is putting some downward pressure on inflation, and I feel that keeping that stance for some time, we'll be data dependent, driven by the data, the evolution of the economic outlook, and also the risks to achieving our goals. We'll always be data dependent, but right now I think it is very well positioned. The economy is doing, like I said, reasonably well. A solid labor market, and so we have the ability to collect more information, more hard data to complement the soft data we were talking about, and really make sure we got a clear picture of what's going on. So I do feel that monetary policy is in a good place.
You said you're looking to hold rates for, quote, some time. Given that we could see multiple rounds of this tariffs, maybe if there's retaliation or negotiations, also creating more uncertainty about the path forward for the economy and I'm sure monetary policy, do you foresee potentially holding rates steady through at least the spring or even into the summer months?
Well, you're asking me to predict the future, and I think, as I said, the situation is uncertain. We need to follow what we're learning from the data, from all the information we collect. But again, like right now, where we are today, I do think that we've got monetary policy well positioned to navigate, various scenarios. But we'll have to just keep watching how things evolve and just stay focused on achieving maximum employment and price stability.
Does fewer than 2 cuts seem increasingly likely?
Well, you're getting me out to all the way through the end of the year.
I'm trying here.
Yeah, and it's we put out our projections. These are participants serious efforts to think through of things that can happen. I would highlight that for me personally, the point estimate is not the thing that I'm so focused on. I don't know what exactly is going to happen over the next 9 months or where the monetary policy needs to be in the next 9 months. Much more focused on making sure that we have our policy well positioned to manage any circumstance that comes our way, and we're ready to shift policy if it's appropriate to achieve our goals.
But you did say later in the year, I heard that right?
To later in the year what?
In terms of the cuts.
I didn't say anything about later in the year in terms of cuts. I just continue to assess as we get more information.
Let me ask you this, President Williams. If long-term inflation expectations were to become unanchored, would that be the trigger to raise rates, or would rate hikes be on the table ahead of that? Because if you got to that point, it may be too late.
Well, my view is we need to keep longer run inflation expectations well anchored. This is the thing that has really helped us, and more importantly, the U.S. economy over the past 5 years. We went through these enormous shocks to our economy through COVID, through Russia's invasion of Ukraine, everything that's happened over the past 5 years, and longer run inflation expectations remained anchored. So it is our job to make sure that that continues to be the case, both through our words and our actions. So that to me is absolutely critically important, so that we aren't asking the question, well, now that inflation expectations are becoming unmoored, what do you do? We just need to make sure that we keep them well anchored as they are today.
There's a lack of clarity on why the Fed decided to slow down the balance sheet runoff now. So why now? Was it anticipation of hitting the debt ceiling? Was it perhaps trying to avoid a repeat of 2019 where there was dislocations in the money markets given volatility that we're seeing now in the markets? Why now?
Well, we set out back in 2022, the FOMC set out a strategy, a set of plans to bring down our balance sheet and get to a point of what we call ample reserves, a system of a level of reserves that can support interest rate control. And so that's what we set out to do in 2022. We have been executing that plan very well. We've reduced the size of our holdings by over $2 trillion during that period, and it's gone very smoothly. Now, we did say in our plans that over the course of this process, we would slow the speed of the reduction of our balance sheet, kind of, just take as a prudent step to make sure that we didn't run into any, bumps along the way. We did that once before. We cut the speed roughly in half of the shrinkage of the balance sheet. We just cut it by roughly a half in terms of the actual reductions in our balance sheet. So this to me was the natural next step in a process that's going extremely well, making sure that, as we get closer and closer to maybe this ample reserves or somewhat above ample reserves level that we're aiming for, that we're coming in at a slower speed and we can collect data, understand what's going on, and avoid any unnecessary bumps along the way. So to me, it's just a statement of carrying out or executing on the plans we set a few years ago and doing that in a way that minimizes any disruption in markets.
President Williams, we'll have to leave the conversation there, but thank you so much for your insight. I so appreciate it.
Thank you.
That was President John Williams of the New York Federal Reserve. I'll send it back to you, Josh.
Thank you, Jennifer. All right, Christine, we just heard from New York Fed President John Williams. I'm going to say the word uncertainty was a theme in that interview, Christine. So asked about tariffs impacting the economy. Williams saying, listen, it's early days. There's lots of uncertainty. He's looking carefully what's going to be implemented, wants to see how other countries respond, and watching the data, of course. Jen also asked Mr. Williams, are odds of a recession rising? Clearly, Mr. Williams didn't really want to go there. Simply said, no, actually. Solid economy, strong labor market. Economy, he said, was in a very good place. But again, he said uncertainty about how exactly the economy evolves as policy evolves.
Jennifer tried. President
Yeah,
Williams
gave it her all. Gave it her all. She really did.
Wasn't giving, but you're right. He used uncertainty, but he, to bring back to our earlier conversation, he said, let's look at the hard data. We're kind of getting caught up in the soft data, but they want to, look at the hard data
Does that
and
flow
react.
with the hard data, right?
Right, and to his point, yeah, the economy is still very strong. Unemployment at 4.1%, historically very low. Yes, inflation's up over 2.5%, but we're not in that stagflationary environment. As of yet. He didn't
want to go there. I mean, generally push him, are we facing stagflation? Because to your
Right.
point, that's the word that's kind of bubbling up. And Williams saying, no, not when he looks at the unemployment rate and the inflation rate, where they are right now.
And then also she pushed to understand how many cuts could we expect. We know the Fed has said we're kind of in wait and see mode. We're not trying to rush or go too far. What's funny that's materialized in the last couple days is we've actually seen futures discounting the U.S. economy to weaken to such a point that the Fed might push for even 3 cuts. Just a few weeks ago, headlines were, will we get any cuts because of the inflation data that was coming in. Now we're actually...
Fed back in play.
Absolutely.
Yep.
So now we're seeing, potentially, if you look at the CME Group's Fed Watch tool, is there, the probability of maybe a June and July cut? She asked, what point of the year? She thought maybe he said towards the end of the year, but now we're looking at maybe a June and July and then one again in the fall. So has the economy weakened to the point where that would necessitate more cuts? Again, President Williams not really giving there, but but that's something that's a story that's
To
changed.
your point, Jen, try to get in there. She says, listen, do you anticipate holding rates steady through spring and summer? He wouldn't go there. Uncertain, he said. We're waiting.
Yeah, and he can't, and same on the recession question, like who knows, right? We've seen a bunch of these banks come out and, Deutsche Bank, 50% probability of recession, but who can really say? We haven't seen enough data come in, and again, going back to tariff policy, trade policy, we don't quite know what that looks like yet. So uncertainty has been the word of the quarter, and I think it will continue as we, start to get some of these earnings reports next week. I fully expect companies to have a cautious tone.
On the conference calls.
Yes,
that is a safe bet, Christine. I agree with you. All right, we are just getting started here on Market Domination. Coming up, some Mag 7 stocks getting hit hard today. We're gonna check in on those as well as some other trending tickers on the other side. All right, now time for some of today's trending tickers. A few Mag 7 stocks under pressure here, like NVIDIA, Tesla, Amazon, and Microsoft in the red in today's trade. So, Christine, you look at these Mag 7 names, and obviously they were the place to be, and now they've come under pressure. NVIDIA, I'm just pulling back the chart. NVIDIA's down about 20% year to date. Same with Alphabet. Microsoft's down around 10% so far this year. Different themes, puts and takes there. I mean, that sort of mega AI trade and trend seems to have lost some momentum. So maybe some of that, some deep sea creeping in there, maybe some concerns about slowing economy. But what do you make of it?
Yeah, they're really trying to, go back to that meteoric rise we saw last year, but it just hasn't happened for many of these names thus far. It's interesting though, like I said, the base case for many of them hasn't changed much. I think you're seeing investors react this way because there is that move from the growth, which used to be the safe haven, right? Last year it was like these names were like being in gold. It was like you knew they were going to, you could do no wrong if you invested in these, right? Now we're seeing that pullback and moving to some more of the defensive names. But if you look at like comments from CEO Jensen Huang of NVIDIA, if you look at Blackwell, orders so far this year, over 3.6 million. So it seems like the demand is still there. Looking ahead to some of the earnings expectations, Q1 was still very strong for many of these names, particularly NVIDIA. Amazon, looking at earnings growth of 40% year over year. So some strong numbers still there, but yeah, like you said, it's certainly not what we saw last year. And I think if you're doing that year over year comparison, it looks a little bleak. The AI trade not as strong as it was last year, but to bring it back to that word uncertainty, it's that investors are just not sure where these are going to go based on policy that's coming forth, based on consumer demand, and so there's a bit of a wait and see here.
Yeah, it is interesting to look at the Chinese tech. You look at the K-Web,
Yes.
which is up like 20% this year. So Mag 7 under pressure, but not all tech here.
And a lot of those Mag 7 CEOs said, look, this is better. DeepSeek, the fact that they can do less with more and
Lower the cost,
encourage more
demand,
is
yeah.
good for all of us. And then you saw Meta, you saw Alphabet come out and increase their AI spending for this year, just kind of doubling down and not sort of afraid of the emergence of DeepSeek, but just running with it. This is best for the entire industry.
All right, let's move on. Sticking in the tech world, CoreWeave getting hit with some sharp losses on its first full trading day. So we've got a couple different IPOs to talk about here. Some making news for good reasons, others not so much. CoreWeave, obviously not impressing investors here, made its debut last week. Under pressure. This is cloud computing provider, NVIDIA backed, much talked about and discussed AI startup, Christine. One stat that was interesting, Bloomberg noting that the 76 companies that have gone public this year in the red now, year to date on a weighted average basis.
Yeah, this was supposed to be the year that IPOs returned with a vengeance, right? It's been weak the last couple of years. We haven't really seen any meaningful IPOs since post-COVID. So this year the environment was going to be right. Interest rates were going to come down. More companies were going to go public. And like you pointed out, not only have not many gone public, I think last I looked Q1, we saw about 90 companies going public. That is better than the last two Q1s. So we're getting there. But when you see a reaction like this, it makes me think about other potential IPOs and how those looking to go public might take a step back and say, well, the reception wasn't great, so now maybe. And then plus all of the companies getting private money. Look at OpenAI, Stripe. They have chosen not to go the public route, but in fact just get private money. And so that seems to be the way some of these are going now. And certainly a story like the CoreWeave story within the AI space isn't going to help if you're deciding if you're the next to go public.
And then we have CoreWeave, but then here's another fresh ticker. Get your thoughts on this, debuting today. That's Newsmax shares. Now they are skyrocketing in their trading debut here after, of course, $75 million initial public offering. So this one is soaring, Christine. Of course, conservative media outlet, now officially trading on the NYSE, ticker NMAX. What a move. And in terms of its place in the broader competitive landscape, saw the CEO, that'd be Christopher Ruddy, telling reporters today, Newsmax, he says, is actually the number 4 cable news channel, he said, in the United States, right behind CNN. But what a reaction here to the stock.
I saw that. Like you said, certainly buoyed by Trump being elected president.
Yeah, you would put this up in sort of the broader Trump trade. You think that's getting caught up in that?
Right, it's certainly getting caught up in that, but that stat that I heard that as well, the 4th most watched news network, would just absolutely blows my mind. And so the stock was, I think, halted at one point today because of its rise. But yeah, a complete different story than the CoreWeave. And that story may have been flipped last year had these two debuted.
Yeah, interesting. Soaring today and plenty of eyeballs for Newsmax. All right, coming up, an array of options remain on the table for what Trump calls Liberation Day. We're going to break down what you need to know on the other side. Stick around. Much more market domination still to come. New developments raising the stakes for President Trump's coming promise of vast new tariffs as an array of options remain on the table for what Trump calls Liberation Day. For more on what we can expect, let's welcome in Yahoo Finance's Ben Werschkul. Ben.
Hey, Josh. Yeah, so the latest this afternoon is we have the when and the where. The White House press secretary announced that these Liberation Day tariffs will be formally unveiled Wednesday in a Rose Garden ceremony at the White House. So we know that. The big problem, as you alluded to, is we don't really know the what yet. And this is because it's a sort of Trump's set decision to make, and he is kind of taking his time on it. This is widely expected to be a decision that waits up until the very last minute, even though these duties could come into place. The White House House press secretary did offer, I think, a bit of a hint this afternoon when she listed five trading partners that she said had a disdain for the American worker. It was the European Union first, Japan, India, and Canada. And she affirmed that these are going to be country-by-country duties that are unveiled, in addition to some sector-specific duties that are also getting implemented this week. It sort of sets to a bottom line here that these are duties that Trump has a real sort of set authority to make, and he has the ability to sort of put them into place really quickly. So it's a very unsettled thing, and it could be everywhere from, as he said, kind of beneficial to the countries. People might be surprised markets, but on the other side, this idea of a universal tariff, which is now back in the conversation.
So Ben, hi, Christine here. Do you have any sense of what's real and what's not with these tariffs?
For sure, yeah. So I think there's a pattern that's emerging with Trump here a little bit. So far, we're only 2 months into administration, but I think is illustrative here is that he sets these self-imposed deadlines, promises 5 things, and then actually moves forward on 2 of them or whatever, whatever the ratio is here. The other ones get either sort of put aside or delayed. I don't have any sort of set prediction that that's going to be the case, but I do think that's an illustrative pattern that we could see play out this week, and it leads to a sense of that maybe that it's a sort of a last-minute backtracking, even if he does impose it in a week's time. That's kind of my long way, Kristen, of saying I don't know what's real or not here. The one I would definitely watch from certain is Europe. I think Europe is the one target of Trump's ire that's perhaps one of the things he's most unhappy about is European activities, and he hasn't really acted on yet. So I don't think it's a coincidence that Caroline Leavitt listed the European Union first, and I think that's going to be a big target on Wednesday. The sort of how of it is still very much probably won't be decided for days.
Ben, thank you. Appreciate it.
Sure thing. Talk soon.
Stocks mixed today as trade war worries mounted in the run-up to President Trump's tariff bonanza later in the week. For more on the impact markets are feeling, let's welcome in now Ryan Dykman's Dunham & Associates Investment Counsel Chief Investment Officer. Ryan, it is good to see you. So I see here, Ryan, you are underweight equities. We are down, Ryan, about, let's call it roughly 10% from the top, but you must not believe all the bad news is priced in here.
Well, that's true. I don't believe all the bad news is priced in. And actually, the way we're doing this is with a systematic overlay that we implement called Dunham DC. And so what this program has done is basically said, hey, equity prices relative to the historical averages have run up so quickly and so much, we should underweight equities by more than half of what we would normally have. So your 60-40 investor is currently with us sitting at about 33%, but that's because we bought a little back about 2 weeks ago when markets got near that low that we saw around the 12.
So Ryan, if you don't like equities, where are you looking for the best opportunities right now? Is it fixed income? Where do you look next?
Sure. So fixed income for us is an interesting spot because obviously there's been some higher correlation there. Obviously with the rate moves and anticipation last year, we saw a lot of the movements in the equity markets kind of translate over to the fixed income side. So what we've done is we've actually taken that fixed income allocation we have, which is what we are trading into and what we're buying when we sell equities. And we've implemented a high amount of alternatives, things like merger arbitrage and things like long-short credit. And those make up a sizable amount of our fixed income portfolio, along with bank loans, right? So something that's high yield and maybe a little scary when you hear the recession word. But that's another spot that we've put about 60% of our allocation to within that fixed income to try to bring down that correlation and make it not feel as much like equities.
Ryan, I'm just curious, if you're underweight equities here, when you're talking to clients, how do you explain to them what maybe data points or metrics you and your team watch, Ryan, closely that would suggest you, okay, time to get more constructive?
Sure. So when we're looking at this, we do pull up a longer history, right? We think that markets over time do move up. Markets are not one of those things that's been, sideways for long periods. You're not getting compensated for the risk if you do that. And so what we show them are those long-term periods. We show them those periods of dislocation where we saw like an 08, even 2018, 2022, those drawdowns that you would see. And we show them that and say, look, these are generally shorter term in nature. So if we can trade around them and participate in them, with dry powder, because we've taken that money out of the equity markets, that can be beneficial. It can also lower the overall risk. And that's a bigger piece of this. People are very scared right now investing, not just because markets have taken a step back, but because of how high valuations have been for so long now. We've had 2 years where we had such extreme run up so quickly that investors feel like, am I buying it at a top? And they've asked that question as it went higher. So having this system that we use, the Dunham DC, we're able to cut that back. And we're able to say, look, we've calibrated this to current markets. We feel a little better about having less equity risk now. And there's still exposure. We're not going to zero in equities. That's not how my model works. But it does take it down. And it does take it down gradually. And I have a silly thing that I like to say, that I'd rather be generally right than precisely wrong. And that's because we're dialing out as they went up, and we're going to be dialing back in as they come back down.
Ryan, when it comes to your equity allocation, I saw your overweight value versus growth. We've been waiting for some time for value to return every year. For the last couple, we've said that. Is this the year that we see a return to value? It certainly seems so. They are trading at an attractive discount to fair value. I'm wondering if you think this is finally at 2025 after a decade or more where they underperformed growth. Is this the year that we see a return?
Yeah, so that's a great question, because I've been very bullish on value over growth for some time. So I've been wrong for some time, is the way to put it too. We see that risk thin growth. I think it was just you weren't getting compensated much for it. But then we saw the run up like we did. We saw the Mag 7 just flying ahead of everybody else and driving those markets higher. But with that, I do think that value will have its day. I don't know if it's going to be this year. I mean, we do think in segments, so like small cap value, that's an area that we've been more bullish on and had a higher overweight to within our models. And so I do think you'll see pockets. I think there will be some sectors that do see some, light at the end of the tunnel for that relative valuation. But I don't know, as we look at growth, it's still an engine. It's still something that, when investors pour back in, there's $7 trillion in cash, right? Where is that going to go? And I think that if growth starts to have another tailwind again, that's a good recipient for it. So I am hoping for that reversion to the mean. I think we get it over there 5 to 10 years. If 2025 is it, I'm not sure.
Ryan, we almost made it a whole interview. I didn't even ask you about the Fed, but I'm going to sneak a last Fed question in there, Ryan. I'm curious about your expectations for the Fed this year. Do you think, Ryan, they cut this year, and do they cut? Would it be because inflation finally gets back to target and stays there, or is it because the labor market weakens and Jay Powell's going to think, all right, I got to make a move?
Yeah, I think we might get a cut. I don't know if we're going to get 2 or 3 like we're seeing priced in. And I do think it's going to be because of concerns about, again, that R word getting bigger and bigger in people's mind, that recession idea, being concerned about that, and if things are headed in a bad path. So I don't think the Fed wants to be late to this. I think that is something that they might do a cut and then see how that feels. Because 425 at the top end is still going to be, on the tightening side. That's not easy policy at that point. So they can still claim that they're still on the tighter edge. And I think that gives them room to still move down in case things do get worse. I don't know if we're going to see 2 cuts or even 3 cuts. I think that's a bit of a pipe dream at this point.
Ryan, great to see you and great to have you on the show today. Thanks for joining us.
Thank you.
Well, coming up, with Trump's auto tariffs looming, how much could the price of motorcycles rise? We're going to speak to an analyst on the other side. Stick around. Much more market domination still to come. All right, time now for a look at our calls today. Celsius is getting a lift at Truist, firm upgrading that stock from hold to buy and raising its target to 45. Christine, so basically this one comes down to saying it's a Alani Nu acquisition. Christine gives it an extremely strong position in the women's segment of the U.S. energy drink category. The analyst says it sounds like some actual concerns about the broad energy drink sector, but does continue to believe, for example, the male segment continues to stagnate, if not decline, in the U.S., but it's the female segment generating 110% plus of the category growth going forward. They take this one to buy.
I know, interesting because, frankly, hadn't heard of Alani Nu.
That makes 2 of us.
But I did see Celsius last quarter wasn't so hot. This, sales dipped about 6%. Some of that was due to competition from, like you said, some of those more male-dominated energy drinks like Monster or Red Bull. But they have about a 16% market share of this female energy drink market. So I'm curious where this one goes, because like you said, overall it seems like the energy drink market was taking a bit of a dip. I don't know if there's like some health benefit usually that the probiotics tend to help some of these names, but interesting to see from hold to buy.
Analyst says consensus contemplates 25% growth for Alani Nu in 25. We believe they told their clients the full year growth rate could be at least 40%. So buy target 45. We shall see. All right, President Trump's tariff battle focused on the auto space, we know, but it's not just automakers reeling. Harley-Davidson on a wild ride of its own as Europe threatens a 50% retaliatory tariff on American-made motorcycles. And this isn't the first time, of course, the company has faced the brunt of tariffs. Joining us now is Jamie Katz, Morningstar Senior Equity Analyst. Jamie, it is good to see you. So there was this good piece in the Journal, Jamie. It was kind of noting if the EU imposes 50% retaliatory tariffs on Harleys, prices could soar. And so, Jamie, I'm wondering, investors, you're reading that, you're thinking through that dynamic. How should you try to think about what that could potentially mean for Harley-Davidson?
Well, I think there are a couple different things to factor in here. The first is that in the last cycle of tariffs, there was some sort of exemption that occurred as Harley was able to manufacture some of its bikes abroad and then allocate those units to the EU. The other piece is, when you looked at the composition of retail sales in 2024, really only 1/3 of the retail sales of Harley bikes were happening outside of the US. So in reality, if a bike is $70,000 or $80,000, it's probably priced out of demand. But hopefully, I think the idea is that maybe there can be some persuasion that this doesn't occur so that the European makers don't have the same sort of tariffs or retaliatory tariffs coming into the US.
So there's obviously a lot of uncertainty around what's going to happen with the tariffs. So we're not sure how that's going to impact Harley-Davidson, but I think also there's really stiff competition from European motorcycle makers, right? So that can't help if on top of an environment where they're already seeing a lot of competition from their peers, that their bike prices might be higher, correct?
Yeah, I think that's a great point. If you look at the last slide deck the company put out, they basically said their market share in the US has fallen to 37%. Now, this is a company that for many, many years was above 50%. And when you look at the EU market share as well, we're looking at 5% market share now. So basically a player that used to be a very important player is shrinking, and sort of how do they reinvigorate themselves to become more relevant, I think is a much more pertinent question than how do the tariffs impact them at this point.
Jamie, I'm curious, so what Harley wants, per the Journal, is its overseas rivals, I guess to face reciprocal tariffs when they would export bikes here. Jamie, what kind of companies, what brands, what names would we be possibly talking about?
I mean, if you think about Triumph, Ducati, and then other names from, Asia that maybe are coming in, it would be helpful to have against like Honda or Yamaha, of course. But I think China's been a much bigger target out of this administration than the EU has in recent weeks.
Jamie, and how does the jittery consumer play into this? I can't imagine discretionary items such as motorcycles do very well in an environment where consumer confidence is plunging the way that we've seen it right now. We've seen other discretionary items such as travel, leisure, other things that you tend to see do well in very bullish environments. How does that weaker consumer play into the whole Harley-Davidson narrative?
Yeah, I think we got a great data point update last week from BRP, who also makes snowmobiles and ATVs. And the rhetoric that came out of that call was really that the consumer is sort of on pause right now for some of these big ticket durables, right? Everybody wants to wait and see. If you look at the personal savings numbers, it looks like consumers are holding back just to assess exactly how maybe some of these policies are going to play out and how it may impact their pocketbooks, on a magnitude basis. I think it's been really hard for people to get at what that ultimate impact will be. So a lot of caution still, and I think that's probably what we're going to hear coming out of these companies again when they report Q1.
Jamie, I'm curious, who buys Harleys now? What's the demo? Do we have line of sight there? Is it men, women, high-end consumer, middle, low? And how has that sort of been evolving over time?
Well, I think, this business has gone through a couple of different iterations, right? Under the prior CEO, they were trying to get into smaller displacement bikes. And then Jochen Seitz came in and said, we're going back to our core competencies. The problem with the core competencies is that is a shrinking market, right? That touring and cruising market. And so you're generating lower volume and maybe better profitability, but perhaps not adapting. So I think when you're looking at the consumers, it hasn't shifted very much. I don't think there has been a vast adoption by women. They've had pushes into the Hispanic market. But at the end of the day, I think you're still looking at that core sort of Caucasian male over 35, and the ability to tap into discretionary income is a lot more difficult for that consumer than it was 20 or 30 years ago when, houses weren't expensive, medical treatments weren't as expensive, student loans weren't as expensive. And so the pie has just sort of shrunk on them. And I think that's been a huge headwind in expanding into a wider total addressable market.
Jamie, thanks so much for joining us today. Appreciate your time.
Of course.
While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.